Hello and welcome back to our Insider Interview series. I'm Dave Baxter and joining me today is Henry Dixon, lead manager on the Man Income Fund. Henry, thank you for joining me today.
Thank you for having me.
So Man Income has had a good run in the last few years, but it's one of hundreds of UK equity funds out there. So what actually makes you different from the competition?
So I'd probably at a high level highlight three things. Firstly, I think is the yield premium on offer from the fund. I think we target something that's 20 to 25% higher than the market yield. So I think that can be helpful, particularly for those clearly looking for the income. The second point I think is around the distribution of the income. We're very happy to distribute it monthly to our clients, and I think they appreciate that monthly revenue stream coming in from their investments. And then thirdly, I think it's the contrarian value approach that can, hopefully, say the target, and indeed that has been the case over the last 3 years, has been outperformance versus the Retford benchmark, which hopefully puts it towards the top of the peer group.
So let's talk about that contrarian value focus. If I look at the performance tables over recent years, many of the top performing UK funds do have a value bias. What's different about your value style?
So I think within value, the key things that we're trying to target are certainly the long run value measures, be it invested capital, and we're looking at returns on capital. So that's really how we would try to define value. I do, however, think it's important to have awareness of other factors which are really important for equity returns. So, for example, within the quality aspect of investing, we're absolutely determined to try and isolate some of the best balance sheets, because I think balance sheet strength is absolutely crucial. And we define that as low debt, but also high free cash flow yields. And then finally, I think within momentum, that the momentum aspect that we're most keen to incorporate in the fund is earnings momentum. And I think, put simply, if we can construct a portfolio that's cheaper than the market, with a better balance sheet than the market, and positive earnings momentum, then I think that is statistically a very strong bedrock for future outperformance.
And, value investors have coalesced around areas like financials, that kind of thing. Are there any particular names that you would identify in the fund as being more kind of contrarian and a bit different?
Yeah, I think certainly, it's always the case that a few years ago, what seems quite sort of mainstream now was very definitely contrarian, but certainly 3 to 4 years ago, financials themselves were very contrarian, but we had a huge change in the interest rate narrative, and that precipitated some very strong returns. I think something that we did towards the back end of last year was actually get ourselves underweight banks just at a time they were becoming very fashionable. So I think that was to some extent quite contrarian. And where we've gone with those proceeds, I think, is other areas of the market that find themselves on half book value, which is absolutely where the banking sector found itself 3 to 4 years ago. So we'd highlight areas such as real estate, for example, where we've got. I also think we moved quite early on mining last year. We had some really good sort of nascent signs of earnings momentum coming from some very good long-run valuation measures. So that'd be another area that now feels quite, if you like, mainstream, but certainly at the moment, 6 to 9 months ago, it felt quite contrarian.
And is that underweight on banking a kind of valuation-led move, or?
So it is in the main valuation-led. There are pockets of opportunity, certainly, but if I think about where banks have gone over the last 4 years, it's from half book to the best part of 2 times book in certain cases for some of the mainstream UK large cap banks. And that to us feels like the top end of expectations for valuation. I still think there are areas of opportunity within banks. We very much like the Irish subsector, for example. So we're drawn to what are some of the highest capital ratios in Europe within the Irish banking subsector. And we also think that there's a very conservative assessment around risk weights. So that's essentially saying that the marks they take on their assets are very conservative. And that can, again, drives us great confidence in the excess capital position we think we see within the Irish banking sector.
So by now, we're very used to hearing about the fact that managers think UK shares are undervalued, but we have seen a big rally in recent years. So in that context, what is still cheap to you, and where are you a bit more concerned about valuations?
Yeah, so quite a bit to discuss there. I think, look, certainly it's welcome that the UK market has, I think, started to perform a bit better. It's done it in the face of pretty poor sentiment and continued outflows. So I think the value argument has really started to bear fruit, driven by attractive dividends and also the move to share buybacks, which has really catalysed some share prices. I think what I would say with regards to the performance is in keeping with some other indices around the world is it's been really quite concentrated in just a few names. So that concentration by definition means that there is quite a big opportunity in the areas that just haven't participated to any degree. And I think we look at some marked outperformance of some of the larger cap companies in the UK, which I think have left opportunities presenting themselves into lower down the market cap spectrum in the FTSE 250 and in the small cap arena. And that's certainly where we're starting to take our proceeds. For example, I mentioned in banks, and we're starting to try to rotate into opportunities in that area of the market.
And can you give me some examples that are standing out from the small and mid cap space?
So I think what I'd talk to is a few sectors and ideas within those. So I think I mentioned move into some real estate. I think as an extension of real estate, I would also look at some of our construction names in the UK being on valuations akin to where we saw them during the global financial crisis. I think the environment out there isn't necessarily completely straightforward, but nor do I think it's anywhere near quite as difficult as it was during 08 and 09. So I think those type of valuation benchmarks look to us to be good opportunities for us to be trying to capitalise on. I think the other area that we'd take on with slightly sticky inflation in mind and maybe interest rates staying higher for longer is some of the financial sectors I think look very interesting to us. It's possible for us within specialty financials to find trading businesses trading at nearer 10 times earnings, net cash on balance sheet, very positive earnings momentum. And I do think the trading outlook for those businesses, given the volatility, I think continues to be pretty favourable.
Yeah, and what kind of examples are there from the kind of, you talk about leaning into the small and mid-cap space?
Yeah, so further to real estate, I'd certainly single out some of the construction names within the UK, which I still think have a similar asset theme, namely within the house building sector and the RMI. We can look at valuations today which are akin to where they were in the global financial crisis. I'm not absolutely pretending it's easy out there at the moment with stickier inflation, maybe a more mixed economic outlook. But I think definitely where we can find valuations that stack up against that period of 2008, 2009, then I think we'll be well rewarded if we take the other side of that opportunity. Other areas with inflation staying higher will also be interest rates maybe staying higher for longer. So I think that brings in some of the areas of financials. We can definitely find some trading businesses within financials at near enough 10 times with excess cash on balance sheet and enjoying positive earnings momentum. And as I say, that interest rate backdrop I think will lead to a positive earning momentum sticking around for longer than people anticipate.
How much leeway do you tend to give when you get shares with either low or no yield? I noticed, for example, that AstraZeneca, the biggest name in the index, doesn't seem to feature in the fund, or at least your top holdings list.
Yeah, so we're absolutely not afraid of having no weight in large constituents within the index. I think it's important to have that active approach, and if they don't meet the yield criteria, then I think it's appropriate that we aren't weighted. That being said, we do have a portion of the portfolio that we're specifically targeting dividend growth. Here we're trying to isolate strong balance sheets as defined by net cash and also excess free cash flow yields. And the hope is if we can marry up those two aspects, then we can isolate dividend surprise or at least shareholder return surprise. It might come in the form of a buyback, but that will be well rewarded with regards to capital upside.
Henry, many thanks for your time.
Thank you.
And thank you everyone for watching. We hope you enjoyed the video. Do let us know what you think in the comments. And as always, if you're enjoying this series, hit the like button and hit the subscribe button. Take care.